right, fire ahead, Brett. What's your first take?
My first take is, it wasn't anything really remarkable that happened there. I guess I thought there was one questioner in the Q&A that really stood out to me as a really exceptionally insightful question, and I really should have added this to my argument earlier about why one might expect a surprise cut today, because this is a really unique situation of the Fed telling us in advance that it's going to be cutting at some point in the future, pretty much, and the danger of that is, just like the questioner asked, that is a self-fulfilling prophecy because it messages to the marketplace that you're going to have better borrowing rates in the future. So don't borrow and spend now. So make major investments in the future. Use credit in the future. Wait until the rates are lowered. And so it becomes something that is a deflationary force. Yeah, just telling people in advance that rates are going to be better, money's going to be cheaper in the future than it is now, will simply cause people to wait on making major investments, and I think it's a real error in their strategy.
Yeah, I guess my counter-argument to that would be, don't you think the bond market's already done that for them?
Okay, depends on where you're...
The 10 year's down below 2% now, right?
So yeah, sure, and there's longer term rates, and that's possible, but I suppose for the major lenders, but yeah, right, it's possible that the market is doing that for them, but it still could be on the margin a slightly deflationary force, just to say that the short end policy rate is going to be lowered in the future and keep it up now. This is the sort of forced continued 3 month to 10-year yield curve inversion that I was talking about when we talked a few minutes ago. That seems to be the primary effect of what they did today, is to lower their inflation expectations and then to maybe lose a little credibility about how important those inflation expectations are by not cutting when they are already moving their expectations, and then also to suggest that they will be cutting in the future. It just kind of forces that steeper 3 month to 10-year curve inversion. So I think it's just, if they know they're going to do it, I guess that's the point. So here, let me fold it in with another point. It makes sense what they did, but only if he's more explicit about discussing how, very specifically, the trade war is the key swing factor. And he really kind of stayed away from doing that, and maybe that's
part of it. Yeah, he noted it as a factor, but certainly wasn't saying that that's the primary one by any stretch, right?
What he noted in the data, the problems, the boogeyman that's starting to show up, is business spending and investment, and that was very clear. Consumers okay, business spending and investment is dropping like a rock, and that's the problem. And that's obviously the trade war. That's like you don't know what sort of investment you can make because you don't know if you're going to have to reconfigure your supply chain, and that's the point. And really is the reason why the cut became so obvious after the Mexico threat, because that starts to really get at the heart of a lot of big supply chains that would be in play, and also extends to, this isn't just the U.S. and China. This is the U.S. against the rest of the world in terms of trade policy, and tariffs don't have to be related to a particular Section 232 argument or whatever. It's just going to be tweeted out at any time, and it just kind of shifted that. And I think that's when it became such a remarkable move in terms of pushing up cut expectations, and I think that's because of looking at business spending and investment as a part of the economy. And it seems like if he were to be a little bit more explicit about that, it would help people understand that that's a big swing factor, and it's the reason why this isn't a hit to their credibility about maintaining 2% inflation, which now it looks like one if he doesn't make that point, because they're forecasting well less than that and not cutting rates. It either says that they have a problem with the transmission mechanism, or they're not that committed to it, or there's a third factor. And if he was a little bit more explicit about that, it would probably have benefited them. So I think he probably should have been.
Well, I did think he kind of touched upon the idea that trade wasn't the only factor, and obviously it's the overlying factor that's going to have an impact on a lot of the other metrics that he was talking about. But one of the comments that struck me as interesting was that he said that the Fed doesn't have any plans to react to one change in sentiment or one economic data point. And, I kind of felt that was a hint towards the recent downturn in trade sentiment, that it wasn't ready to work just on that. But obviously, as we can see, that's going to work its way, and that's been my argument for the last couple of months now, that it's going to work its way into longer term outlooks from a lot of these companies, and I think we're starting to see that play out.
And one point I want to make, you talked about being more overt about there being a cut coming. The market certainly has taken that, right? And if you look at the July Fed Funds futures, have you looked?
No, I haven't had a chance to take a peek at that yet.
There is a 0% chance of non-cut.
There
is a marginal chance of 3 cuts.
This is for the September one now.
July.
For July. Really? 3 cuts?
0% chance of no cuts. Marginal chance of 3 cuts. Decent chance of 2 cuts. 33% chance of 2 cuts. 64% chance of 1 cut.
So basically
0% chance of hold.
50 basis points cut potentially in the July meeting.
Potentially, yeah. I mean, the base case would be a 25 basis point cut, but 0% chance of a hold according to the Fed Fund futures right now.
Yeah. I mean, it wouldn't be unheard of for the Fed to start off with like a 50 or 75 basis point cut, right? We've seen them do that in the past.
Well, yeah, if we see the type of leading indicators we've seen bear through, and it looks like business investment and spending is just going off a cliff right now, and there's no trade deal. And so I'm going to unfold everything that I believe about everything right now into tangling it together with the trade war. So when I was on with Jim in early May, I made the case that immediately after things fell apart with China, that there would be no chance of any trade deal with China for a long time. And I still believe that that's the case. And one of the main reasons is because the general public, we're coming into a campaign, and the general public has become far more educated about the issues with China that would represent a good trade deal than they were a year ago. You could have gotten away with just a deficit restructuring kind of situation, trade deficit restructuring situation with China, and made that something where people thought, oh, the president came in, he kicks a butt, he got a better deal, way to go. And now people really understand the sort of Lighthizer kind of version of what would be an acceptable trade deal, and it's something that China's willing to weather through the election in 2020, in my opinion. So it just seems so unlikely. Trump would truly have to cave to something that would be something that would be very difficult for him, I think, at this point to sell to a lot of people as being a sufficiently tough trade deal. So I think that makes it really, really tough to pass together.
And I think you got the same thing on the opposite side too, which adds to that dilemma there, where Xi Jinping's got his own hawks that he's got to keep appeased over there, and they feel that he's giving away too much, which is one of the reasons why, we got that whole story about them just taking a black marker to the deal and just kind of cutting through a number of different items that were just simply unacceptable. So I agree.
What's an interesting dimension.
Maybe we could see a smaller deal at the start, just to kind of, warm up the markets. I could see both sides doing that just to offset a decline, but I think we'd have to feel a lot more pain. I don't see President Trump doing that near all-time highs, right?
No, and I mean, just as an abstract point to put a cap on it, it's an interesting dynamic that I really didn't think of at first, which is it would appear as maybe that it's just built into the nature of a trade dispute, that the longer it goes on, the more educated the electorate becomes about what represents the real sticking points, which means those sticking points, if both parties they've really dug their heels in about a few points, and suddenly it becomes the case that everybody they want to sell the next election to, or their power structure to, is really educated about those points. The deal just becomes increasingly difficult to get. And I would say that's what's happened here. It's those structural changes. You have to get them if you're Trump, and you can't give them if you're Xi. And it's kind of, I don't see it happening. So in a world where that doesn't happen, what's the Fed future policy look like? It looks like a bunch of cuts.
Yeah. So let's take a look at some of the market reactions that we saw out there. Obviously, we could jump into, we'll take a look at the NASDAQ first, Brett. Well, actually, do you want to take a look at the diamonds first, since that's the trade that you went after?
Yeah, I mean, it's just we had I think a shakeout breakdown pattern in place, and you and I were chatting backstage, and noting that. Could there be some weak hands getting shaken out if a level busted? And it's just the problem with the sentiment picture that we have right now is I'm not sure there are any weak hands on the long side. And it's just it's too fast a rally from too deep a pessimism that people are still playing catch up, and people are probably still, I think the weak hands are probably looking to profit from the fade at this point. And there's still just a lot of money that was too far on the sidelines and too hedged, especially in a world where we have like I said, all-time low unemployment, an S&P that's approaching all-time highs, and a Fed in easing mode. It's just tough, and it's just these little patterns are running against a wall of money trying to get in without chasing too much, and the pullbacks are just really shallow.
Yeah, well, like I said, I was looking for that shakeout of potential weekends, but I'd agree with you. We're not really seeing much of that, and what I was hoping for, because the way I figured it is, I was expecting bulls to come in, but I thought that we could get down to that 50-day moving average around 28.80, just once the initial dam kind of broke here post-Fed, and that's where the bulls would come in. But it doesn't look like anybody wants to let go of the bone right here, and they're just willing to continue to keep buying this up. Especially with the idea of more rate cuts coming down the road. For me, I was looking for the Fed to be a little bit more implicit, but I suppose that they were implicit enough. I didn't really think the message changed all that much from what we'd been seeing from commentary over the past couple of weeks myself. But so we saw you try jumping the diamonds. I tried jumping into the S&P. You cut bait for less losses than I did. I was willing to set it out because I was looking at mine more just as a hedge. But you also took a long in gold. That was the August contract, right?
Yeah.
Okay. What are you seeing playing out there?
So, I mean, I've been long gold in GLD, and that's just a completely separate position. Has nothing to do with this. This is trading around that in the futures market, a full-size position, tight stop. Just, we came up, we hit 1360. That's the key level. We pull back from it. And a breakout through that level would be made of, in theory, there's obvious bets to me as I'm watching this tape. There's obvious bets coming in of playing an aggressive sell off of resistance, because you've got multi-year resistance right there, and we've seen it every time it's come up. I think it's almost kind of like an algorithmic sort of strategy of just you get up to these key resistance levels in gold, it peels back a little bit, you hammer it on the short side, and take your profits. When it breaks back down, it shakes people out of the breakout position, and we kind of rinsed and repeated that for maybe a week or so now, and we did it again early 2018 in the same area, and it's just a long-term 4-year level basically that's been sitting around this 1350 to 1365 area. But the way those breakouts tend to happen is when you get that same kind of dynamic, and it just can't really pull back very much when those resistance level shorts come in, and we just bang up against it, and eventually start to grind through it, and then it's all just a bunch of covering, and you really get, I think, the main part of the breakout is a lot of people who were trying to fade it at resistance who end up giving up. And so I'm just in case we get that here. At this point, I have, pretty much up to just about break even with a stop. It is pretty tight. I may get shaken out, but I could see this being a situation where it really just kind of hangs out here in the 1355 area and maybe starts to leak up into the Asian market action. I will be holding it. This is in the futures, so if you're in GLD, I don't know if you'd want to do that because you may not see a stop get hit. But I could see this being a situation where it could grind up and leak up through in the wee hours of the night when nobody's watching, as we come out of Asia and into Europe, and suddenly we're at 1375, and then, you're starting to set off a bunch of big breakout orders that come in because we're clearly then breaking out to new multi-year highs in a dovish Fed environment. And as I said earlier, the one thing we know for sure that came out of the Fed today is that the Fed understands the universe right now, where if there is no trade deal, then it could be years before we see a hike again. And that, that could be a pretty good environment for gold. So it makes sense, and it's acting like that's a possibility. So I'm going to hold it. If it shakes down below 1352, I'll be back out of this, but I'll still be in the GLD.
Okay. Let's take a look then at the bond market. I saw that 2% level for the 10-year was holding up, but the TL2 is stretching up a little higher here on it. Any thoughts on bonds?
I mean, it's the same thing, really.
Do you see rates going down much lower from here? Or do you think this is the market will be showing us exactly how tough the situation looks. I mean, I would think we're getting to some pretty powerful levels here as far as just the sheer momentum behind this move. But, again, what changed today was the Fed basically saying that it could be a long, long time. And maybe the bond market is starting to say, is taking a similar opinion that I expressed about the likelihood of a trade deal. That's another way to look at it. I suppose that markets are basically going to become a vehicle for expressing something about the likelihood of a deal, and probably rate markets most centrally.
And if we're acting this way, then we would be caught tremendously off guard by a near-term trade deal.
Right. Taking a look next, we'll just take a look at the J&K, which was one of the things that I was looking at. I would note that this is breaking out here. Certainly suggests a little bit more confidence around some of the easing that we should be expecting to see. Do you got any thoughts on the corporate bond side of things? The J&K is really making a nice little run here.
Yeah, I mean, the main thing that I would say is important about looking at this chart is typically if you have genuine inflation or genuine recessionary risk, you see credit spreads blow out, which means you see the high quality bonds rally and the low quality bonds fall. Really, no matter what the Fed does, if we're seeing a breakdown that's a significant move toward a recessionary condition, this would be getting hit right now. So it's interesting to see how strong junk debt is doing in an environment where we're talking about a big breakdown in business investment and about a Fed starting to really go on guard about cyclical concerns. So we are not seeing credit spread widening, and that's in and of itself a really important point.
Yeah, but it could also mean a pretty nasty reversal potentially here, if you ask me.
It could be a lot of stupid money, yeah, that's the other possibility.
Yeah, so I mean that's kind of how I'm looking at it. I'm not looking to chase this. I was more interested on this on the downside, and I'll continue to look in there, maybe even look at some put options for a little bit down the road, because this is one that if the fears for why the Fed is moving do start coming to fruition, then we could definitely see this get beat up pretty good. Let's see, what else can we look at? Emerging market spread. Obviously, I jumped into a long in the EWZ. The Brazil Central Bank, the CELIC, is going to be meeting a little bit later. Could see a surprise rate cut from them. They're not expected to. You got any interest in the emerging markets area? We'll just take a look at that EEM for starters.
Yeah, I mean, there's a lot of people who may have been short EEM as part of a pair trade, where they're just finding a diversified way to be long the theme of divergence in U.S. monetary policy. That's a big theme, and that's the big dollar long. You've seen a lot of people who've been really bullish on the dollar recently, and it really is about that. It's about the idea that we're seeing a shift in policy all around the world, but that the Fed is going to be in a situation where it won't be shifting with everybody, and so today is kind of a hallmark day. And really back to the Mexican tariff threat, kind of, I guess it started then, pretty much, that we're seeing convergence now, it would appear, in terms of policy, and that is great for the emerging market stocks and emerging market debt. So that's definitely a strong long bias kind of situation right now, probably for a lot of people, or at least a cover for people who were short that and long the dollar, looking for divergence to play out.
So speaking of which, we got the euro. I know you've talked a lot about a potential euro squeeze. Do you have any interest in that? I mean, for me, I know Italy's supposed to come back with a privatization plan next week. That could be interesting if this does hit some of the levels that people would like to see in terms of potential squeeze and a breakout into single currency. You got any thoughts on the euro?
I mean, I would have a tough time shorting it now, given what I just said about the divergence scenario. The feel of the tape isn't tremendous to me. So, I mean, it's possible, given that we're coming off of what Draghi just said. But I think that I get that with the gold long, and I'm okay with where I'm positioned.
Okay. Final two questions for you, Brett. What are you looking for in terms of market moves over the next 24 hours will be the first one.
So that's the statement where I really want to say the really annoying answer, which is I'm really interested to see. I agree. Because following
that's why I asked
you
and didn't ask myself.
Yeah, I mean, it's really this is like discovery. This is the really have an open mind and be willing to take in information and then use that.
Right there is the key thing. You got to have an open mind for the next 24 hours and let it come.
Right, it's always the case for me. Following the Fed, we're really like the next 18 hours. By the time we get to lunchtime tomorrow, I'll have a pretty good sense of Oh, we've seen everybody around the world react. We've seen them react to the reactions. We've seen big decisions being made by committee and big Wall Street firms on the top floor, about what this means and what to do with it. And it just takes a while for that. It's that process that we call digestion. The market is digesting what we just saw. And if you believe that the initial knee-jerk reaction is going to define the situation, you're crazy. You really need to let's go all around the world with this. And then we'll start to see. It doesn't mean that you miss opportunities, because it's still going to give you a sense of what the landscape looks like after that. And I often find some of the best trading periods, particularly for markets outside of stocks, but stocks as well, some of the best trading periods are like pretty much the Thursday afternoon and then Friday and then Sunday night and Monday that follow a Fed meeting where it seems like there's important things that have transpired. So I think we start to head into that. And it really is about taking information in until we get to mid-morning tomorrow.
Right. My next question is you're probably going to have a similar answer for Fed Governor Brainard is going to be the first person speaking post-Fed here. Do you expect her to flesh anything out for the markets?
When is it?
Friday morning.
I mean, there will be.
Or do you think she's in a wait-and-see mode too, which is kind of how I see it?
I see them as a team. And I think that
exactly. That's why I'm curious. I always love seeing the first Fed speaker post Powell, because we saw it back in December with Williams when Powell kind of upset the apple cart there, and he stepped in to really protect the markets. And I'm just curious. There's nothing that I think that Brainard needs to really particularly offset. So I'm just figuring that the next thing she has to do is kind of flesh out, and there's really no big economic data until we get there. We got a Philly Fed, we got the leading indicators number, which is not very leading in my opinion. We already know all this data, and there'll be May existing home sales before she speaks, but not a lot of additional data to provide her with any further ammo for commentary.
Well, I'll say this. I think that the first speaker post-Fed in an important Fed shift of some kind, and I would call this that to some extent, given everything that we've just kind of absorbed. I would say that it is maybe a little bit that they're kind of trying to see the narrative that emerges, even in the financial media, in response, and see if it's off from what they really want people to understand, and then that first Fed speaker is a way to put a correction on that. And I think we've seen that a few times where, they're trying to say something, but a narrative starts to emerge, and it looks like people are taking it maybe a little bit wrong. We didn't really mean exactly what you guys are taking it as, so that first Fed speak is a chance to kind of circle back around and confirm what message they really want to be out there. Sort of like a process of doing a sculpture, making minor little adjustments to the form as the narrative starts to come together in a cohesive manner over the following weeks.
Yeah, and one thing I do remiss I left out was we're going to get some of the preliminary PMI data before Ms. Brainard speaks. So, all right, Brett, well, we'll be keeping an eye out on things. Obviously, markets could be pretty interesting here overnight, so we'll watch, because we still got the Brazilian Central Bank, we got the Bank of Japan out later tonight, and then early tomorrow we have the Bank of England. So could see a ton of central bank easing within the next 18 hours. That should be interesting to see how the markets digest that.
Certainly.
All right. Well, Brett, you take care, and I'll talk to you soon.
Okay, great, Gav. Thanks.
All right.